10-year note yields continue to trend lower, have not traded above 275 since FOMC. And if you go back to the January 18th high of 280, that was pretty much when this descent started, just ahead of Davos, when really that was the oops moment for the markets, given the fact that a lot of the talk at Davos was the lack of global growth, or maybe unclear global growth in the future. And that's really what started the trend lower in 10-year note yields. It didn't really affect risk assets, but we haven't really seen an uptick in yields since then. And it started to really pick up steam post FOMC at the end of January, and we've seen it just kind of move lower day by day here as we continue into February. And now the market got its minutes today, it got some information. Now it looks ahead to possibly the chairman's semi-annual testimony to Congress. What could be the next it moment after that? Could be Brexit. There's some big major things on the calendar, but from a technical perspective, we haven't been able to see any big sellers push yields higher, and hence we continue to push lower, nearing the 260 level. 250 would be a real extreme at this point. That would have been that low end of the range. 260 has been the real trading range, 260 to 280. But like I just mentioned, we haven't seen 280 since the middle of January, and we haven't seen 275 since the end of January. So it's been one of those kind of moments in Treasury land where we haven't really seen a two-way trade. It's been very one-sided. And if you look at volatility is getting crushed. And it's getting crushed because the market it's trading its trend. It's what it's supposed to do. When the market does things as predicted, volatility goes lower, despite the fact that we continue to see rising risks overseas, rising risks with trade talks with China, potential for uncertainty with the economy here. We have equity earnings, which look good, but forward guidance not so good, or at least very unclear again. And that would be a signal to me that volatility maybe should be at least trading sideways and not going lower, but we're not seeing that. So yields going lower, trending volatility also going lower. So lower vols and lower yields. And what did we get out of those minutes today? I think a lot expected there to be some clarity on the balance sheet unwind, and maybe perhaps how they were going to change maybe some of their language, or maybe they were going to stop the unwind process and leave the balance sheet elevated and give us some certainty or whatever. And I think the market really, the minutes were a little less dovish than expected, but they didn't get the clarity they wanted from the balance sheet unwind talk, nor did they get it from the global growth talk, which the Fed is concerned with, but certainly will not let that affect their policy. Yeah, right. And I think that ultimately, as we look forward, the Fed says they may still raise rates in 2019. Well, someone ought to tell the Fed that the market's telling them something totally different, because the market doesn't see any Fed rate hikes right now, and maybe the market's wrong. It has happened before, but it's rare. So right now the market's telling you smooth, probably unchanged, with the possibility of leaning towards an ease later on in 2019 into 2020. But the Fed says they may still raise rates. So some conflicting information there. Both can't be right. And obviously, as we get through the year and progress, things may change in the market side. But right now, the Fed, I think, wants to hold on to the fact that they possibly could raise rates. With 10-year note yields trending lower, nearing that 260 level, it's uncertain. It's very clear to me that at least in the short run, as we head into Brexit, I think that's the key event moving forward, that there's not going to be any kind of rate hike in the first quarter. And second quarter will be very much a reaction to Brexit. So we'll have to wait and see what happens with that. But as I said, we are trending lower. We haven't seen a major uptick in yields in quite some time, and that likely will continue. The Fed chairman testimony at the end of February will be the next hit moment. But ultimately, I think all eyes are on Brexit, which is March 29th, and the ripple effects that come from either the hard Brexit or the soft Brexit landing, whichever they get to. Right now, leaning towards a hard Brexit because no deal is in play, and you can see that relative to where yields are trading in the U.S., and that is continuing to go lower.